Hey everyone, I'm Professor Stefan. In this video, we're going to cover some of the kind of more unique revenue recognition scenarios and how we deal with these things. So we're going to talk about unexecuted contracts, we're going to talk about sales returns, and we're going to talk about principal-agent relationships. So let's start with unexecuted contracts. So we've talked about this a little bit before, where the timing of cash flows can differ from the point at which you recognize the revenue on your income statement. So when cash is earned and received, you're going to debit the cash and credit the revenue. So you kind of make a sale and receive the cash at the same time. When cash is received but revenue is not earned, you're going to debit your cash but credit that unearned revenue liability that we've seen before. And then in the other scenario, where you've earned the revenue, you've delivered the goods or services, but you have not yet received the cash, we're going to debit accounts receivable. So these first three buckets we've seen a handful of times. None of them should be all that unfamiliar to you. And briefly, I think it was back in, I forget if it was the income statement or balance sheet class, we talked about these unexecuted contracts where there is no cash received and there is no revenue earned. So you sign a contract with a customer and they promise to buy goods from you in the future. At that point, we are not going to recognize any revenue. We're not going to recognize any asset. We basically ignore this thing on our financial statements. Now, just because we ignore it on our financial statements does not mean it doesn't matter or it's unimportant. So I have a piece of Boeing's 10K here in the notes to the financial statements. And Boeing, right, it takes them a long time to build planes. So they get orders well in advance of when they actually construct those and deliver them to customers. So they have this big order backlog back in 2016. And this backlog is very significant economically. So these are customers that have signed contracts to buy planes in the future. So they are contractually obligated to buy these planes. And this order backlog, so Boeing has not started producing these yet, and they have not received any cash for them yet. This order backlog is on the magnitude of, $450 billion in future revenue that they're going to receive. But because nothing has happened yet, all that's occurred is the signing of a contract, this $450 billion gets excluded from their balance sheet and their income statement. So that's it on unexecuted contracts. If nothing has happened, we do not record any journal entries. So our second topic then is sales returns, right? And you guys have all done this before. You've bought products and you've returned them to the stores. And you can see that there could be a bit of an issue, right? If you're the firm. You make a sale to a customer and you know some customers are going to return those goods, but you don't know which ones. And so you don't want to recognize too much revenue. And so you're going to have to estimate what those returns will be over kind of a given group of sales. And so if we know there will be some returns and we can estimate roughly what those returns will be, well then at the time of the sale, we're going to reduce our revenue by the amount that we expect to be returned. So we don't want to over-recognize revenue or recognize too much revenue. And so let's say we sell $1,000 worth of goods, we collect $1,000 in cash when we make that sale, but we know about 10% of that is going to be returned. Well, we'll only recognize $900 in revenue, and we're going to create a liability for the $100 that we expect to return to the customers who return their goods. Now, at the same time, this estimated return affects our cost of goods sold as well, right? If our revenue is reduced by the amount that's going to be returned, we're also going to reduce our cost of goods sold for those returns. And if we reduce our cost of goods sold, because we're still handing out the full amount of inventory, let's say the inventory that we're selling cost us $500, 10% of that's going to come back, so our cost of goods sold is only going to be $450. Well, then to make this thing balance, we're going to have to record an asset worth of $50 that we're going to call estimated inventory returns. Because if you think about it, when a customer returns inventory, you give the customer cash and they hand you back that inventory. And so with this simplified example, we're kind of assuming here that the inventory you're receiving back has some value. So you record a liability for the cash you expect to pay back, and you record an asset for the inventory that you expect to receive back. And then when the return actually occurs, we're going to pay out the cash of $100. We're going to receive inventory back of $100. And then that estimated liability and the estimated inventory asset return, those both get eliminated. Now, if our estimate is wrong, we are going to have to correct that thing, right? If we underestimated our returns, we're going to receive more inventory back and we're going to have to pay more cash out. So at that point, we're going to have to correct our revenue and our cost of goods sold numbers. Or if we overestimated our returns, we're going to have to pay out less cash and receive less inventory back and get rid of those kind of excess return liability or the excess estimated inventory return asset, and correct our revenue and cost of goods sold as well. And so when we make these sorts of estimates up front, we do our best. And then if they turn out to be wrong, we just correct it once we know better. So that's the basics of how we deal with sales returns. And then the last topic for this video is going to be a principal-agent relationship. And this is when you allow somebody else to sell your goods. And it oftentimes deals with consignments, but there can be principal-agent relationships in other scenarios as well. And so let's think about booking airline tickets, right? There are all sorts of websites that sell airline tickets for the airlines. And one example would be something like Priceline, right? I think that's what William Shatner used to advertise for that, if you guys remember that. So let's say they sell a ticket for United Airlines that costs $300, but Priceline is going to charge a $10 commission on top of that. So that means the customer is going to pay $310. Priceline is going to collect $310, but then they're going to have to turn around and pay $300 of that sale price directly to United Airlines, right? Priceline did not buy this ticket from United Airlines. They're just selling it for United Airlines. And so our journal entry for this is going to reflect that. We bring in cash of $310, but our revenue piece is only going to be the $10 commission that Priceline is actually going to keep. And we're going to record a $300 liability for that expected cash outflow that we're going to pay to United Airlines. Now for United Airlines, they're going to record a receivable of $300, but their revenue is going to be the full $310 sale price. And that $10 that Priceline gets to keep will get debited as an expense. And so they're going to record this kind of selling expense, this commission that they pay to Priceline.com, and their revenue is going to be the gross number on the sale. And this principal agent idea, where the agent, which is Priceline, is only going to recognize revenue on the bit they get to keep, whereas the principal recognizes revenue on the full amount and the kind of expense or the selling expense that they pay to that agent. That holds for consignment arrangements as well. And these are kind of principal agent arrangements for physical goods. And so how consignment works is if I have a bunch of goods I want to sell, but I want someone else to sell them for me, I will deliver the goods to that person. That person is not buying them from me, but they're going to take the physical holding and they're going to sell them for me for a given fee. And so the ownership does not transfer when I give it to that seller, but rather I keep the inventory on my books until they make a sale. And then I record a revenue, I record a cost of goods sold, I record the inventory going out, and I record this selling expense. So one of the interesting examples of this principal agent arrangement is Groupon. So Groupon was really big back in, I think, like the early 2010s. And basically what they do is they sell gift certificates for, restaurants or other activities at a discount. And the way this would work is they would contract with a customer. I was working for I was auditing a restaurant once, and they did these Groupon things. And so what Groupon would do is they'd sell a $100 gift card to this restaurant, but they would sell it to a customer for $50. So basically the customer is getting 50% off. So Groupon would collect $50 for this $100 gift card that they're giving away. And then Groupon would keep half of that. Groupon would keep $25, and they would give $25 to the restaurant where those customers are going to go eat. And so it was this, really costly deal for the restaurants in the sense of they only get a sliver of that revenue that's sold, but they have to provide a full meal that otherwise would be revenue in the amount of $100. And so it was really used as kind of a marketing purpose to get people into your restaurant and hope they would come back at later times. Now that was a little bit of a tangent, so let's get back into kind of the accounting for Groupon. What we just learned in principal agent relationships is that Groupon should only be recognizing revenue in the amount of cash that they end up keeping, right? Because they're selling this gift card for the restaurant on behalf of them. So they're not buying the gift card and reselling it, but they're selling it on behalf of the restaurant as an agent. But what Groupon was doing when they were getting ready to go public is they were recognizing the full $50 in revenue instead of the $25 that they got to keep. So they're filing, their prospectuses and their S1 kind of stuff. And the SEC comes out and says, hey, you're way overstating your revenue here. You need to recognize this on a net basis that you get to keep. And they had to basically have their revenue for their most recent years as they were getting ready to go public. So it was this kind of mini scandal when they had to change their accounting here. So recap very quickly here. We disclose unexecuted contracts, but we do not recognize them in the financial statements. For sales returns, we're going to reduce our revenue and cost of goods sold by the amount we expect to be returned. And we're going to create a liability for the cash we expect to pay back to our customers. And we're going to create an estimated inventory returns asset for the inventory that we think we're going to get back. And then finally, for principal-agent relationships, the agent, the kind of seller, is going to recognize revenue only on the amount they get to keep. And the principal is going to recognize the full revenue on the sale, but they're going to record a expense or a selling expense for the amount that the agent gets to keep for that sale. Thanks for watching.